Hey guys, what's going on? So, in this video, we're going to be going over something called market structure. Okay. Now, that being said, what is market structure? Well, let's just look at what structures are in general. So, if we're looking at structures like a city, there's high rises in a city, right? And these different high rises make up the city. And then within these different high rises, we have different levels to these buildings. And these different levels are just like different floors of the building, which make up the structure of the building. And then within those floors, we can have things like divided. Can I zoom in on this? They have the little floors divided up into like different rooms. And then within these like rooms, maybe the room is divided up into like different sections, like where the computer's at. Like there may be a computer desk right here, and then like a chair right here, and then over here maybe like a small table, and over here maybe like a couch for clients that have like a therapy session. And so there's all this structure to life in the different areas of life. So what is structure within trading? Well, structure within trading is essentially where you draw little lines essentially on the chart, and you pretty much just see where price bounces around within those lines. That's all it is. And so the foundation of making trading decisions here in Forex is something called technical analysis. So I'm going to write this out right here, and if you're taking notes, which I assume you are, then you should write this down because this is it's pretty important. It's literally the whole foundation of how we trade. So technical analysis. What is technical analysis? Well, technical analysis, in the most concise definition I could come up with, is the use of market history and common patterns in market data to identify trends and make predictions about what price is likely to do in the future. Now I'm going to say it again slow, and then after this you can pause this to write this down if you like. So technical analysis. It is the use of market history and common patterns in market data to identify trends and make predictions about what price is likely to do in the future. So let's break all this down step by step. So the first part, technical analysis, the use of market history. So let's just say we have a market, and then in 1975, a certain car was priced right here, and then in 1980, that same car, maybe like a Porsche GT3, was like priced something like that. And then in 1990, maybe the price went down. And then in 1990, the price maybe went back up, or 1995. And then in the year 2000, the price was for some reason up here. And then in the year 2005, the price stayed the same. And then in 2010, the price stayed the same. And then in 2015, prices right here. And then if we're looking at prices, we can say like this is like $80,000. Let's just say that's 80K. And then down here, whenever the car was new, let's just say this is like 40K right here. And then on the bottom, we would have this is like time went on, right? So let's just say this is 1975. And then let's say this is like 2015. So what we do is we've just collected data, right? We've collected data. We've said, here's one of our scales we're looking at, which is time, and here's another scale we're looking at, which is price. So right here, we essentially have a chart in which we've created data within this chart based on these representations of these two areas. So in 1940, the price started, or sorry, 1975, the price of this Porsche maybe was like, 40 grand, went up to like, whatever, 50 grand, and just goes up and up and up. Then it goes sideways in the price. And me connecting this line to all these prices just shows us the historical trend of what price is done. So that way we can just look, and in a very simple, quick way, we can tell, oh, the price in 1975 of this car was like half of what it is right now in 2015 or 2020. Maybe it's gone up even more. It's 2020 now. So the price is like, more than doubled since then. And you can just simply look at this chart and say, yeah, price has clearly gone up, all these different prices, and then we've connected a line that just shows it. Well, Forex trading is the same way. So in technical analysis, we're using market history and common patterns within this market to help us trade. So whenever we're getting into it, let me draw like a Forex chart right here. Forex chart will do roughly the same thing, right? Is like you'll be looking at different levels, and you'll be looking at what price does, and then maybe there'll be something crazy happen, and then price will do something like that. And you're just looking at all these different levels in the chart to help you make your trading decisions. So this being said, if we're looking at price history, what are these patterns that we can look at to help us identify like trends and make predictions? So let's look at the common patterns. So the first thing is that I've showed you what market history is. Market history is just a collection of data of the price of something over the course of a time. So in trading, we can look at this over the course of a day, over the course of a week, over the course of a month, a year. We can look at all sorts of stuff, but you just have a certain specified time period. And then within that time period, you're looking at what price did within that time period. And it creates the squiggly lines in the chart that we use to look at the charts. And of course, you can use like candlesticks to look at this as well. That's what you learned in the previous videos, is looking at candlesticks and stuff like that. So that being said, I'm just using a line to just quickly represent it. On the chart, you'll notice that for some reason, there's areas where price seems to like reverse at. So there's areas right there. There's maybe an area right here. This is a clear area. That's a clear area. And so these areas where price bounces at is areas that we can look at for maybe price to reverse. And so why does price reverse at these areas? It's very simple. Let's say that you bought, I don't know, this car and you could only get it like brand new from Porsche, and you're like you're on a special list to get like this car, a retail value of a Porsche. And let's say you get like a Porsche GT3 and it's like 150 grand or whatever it is. I don't know how much these things are. Let's just say it's 150K new, if you can even get an allocation to even order one from Porsche. Well, you know what you could do is right after that car comes out and you get it, if you were fortunate enough to get one, you could easily the same day, I'm not saying you should do this, but the same day you could probably easily resell it for 20 to 30% more of what it is. Let's just say you resell it for like 180K. So you've made a 30K profit. So then what happens is price will hit this area right here. And then the price of this car, for whatever reason, may stay at that price. And then, it may keep going. And then it may pull down away from here. And then the price of this car a year later may be going for like, let's just say like 160K. So 160 grand. And then what price does is price goes back up here to 180K. And then the person who bought this car at 160 grand, let's say like the rarity of this car increases because like, Porsche stops making a naturally aspirated engine for their GT3 or something like that, whatever. Let's just say that the price goes up for whatever reason in the marketplace. So the person who bought here at 160K, they bought the car from the previous owner, they can now sell it for 180K. But what you'll see, something that happens, very common pattern in the market, is that once price gets to previous prices, like previous highs, previous lows, price tends to pull away from that area. So let's say this price goes to like, 170K. Person has this car, after a few months, they sell it for 170K. And then this person who bought this car at 170K, they know the highest price this car's ever been at is $180,000. So we had the first owner right here, we have the second owner come right here and then sold at this price. Then we have the third owner come right here and price has gone to 170K. Let's just say that somebody buys this car right here and then the price slowly trickles up to like 175, 178K. And then this person checks the market price of the car after they bought it like a couple months later, and they find out, hey, these Porsches are selling at 180K again. And that's the highest price this car has ever sold at out of all time for the past like 2-3 years. And so this person right here is going to be more inclined to say, you know what, if I'm going to sell this car and not lose any money on it, I've enjoyed it for about 6 months. I bought it at 170K. I can sell it at 180K and, cover my taxes or whatever. So this person makes a decision to then sell at 180K. So let's just plot this out on a chart. How does this look like? Let's just say that this is a graph. This is at $180,000. And then let's say the time frame is over the course of 0 years and then 1 year and then 2 years. So this is our graph right here. 180K, this is on the 0th year when the car came out. It was 180K. And then, this would be like 150K, but the first year it was sold. So started here at 150K, and I'll draw that in, 150, whenever the car was new at year 0. And then after 1 year, this car was able to sell at 180K or a few days after, whatever. And the price went down, and then at some point it went back to 180K. So that was the first time the car was at 180K. This is the first time right here. Second time the price gets to 180K right here. And then the price pulls away from it because people sell it at that price. Then price goes up a little bit more and then gets to that same price a third time and then bounces away. This will be the third time. The reason price continues to react at certain prices is because of what has historically happened in the market. So this is a very simple pattern. And it just means that whenever price reaches a previous price, more people are likely to buy or sell at that previous price because it's the best price that the market has achieved in the past. Okay, so let's make some sense of this. Let's look at it in a very simple way. What are these called? These are called price levels. Okay. Now, price levels are simply areas of interaction within price, within a market, and you can look at this on a price chart. So let's just say that the price of that car went up here and it reached a price and it got that price again, and then it reached the price, then it got that price again, and then it reached the price. And then let's say it gets above that area and then it comes back, and then more people buy it whenever it comes back. And then it comes back to another price, and then it starts going up again. When people buy it, when it starts going up again, and then it starts going up. The logic behind these interactions is that people like to buy at previous high and low prices because that's the best area that price has been in the past. And we can look at these patterns by just drawing these lines in the chart to represent, hey, price is interacting here. So let's look at an actual chart, and let me show you this. I'm gonna go find something super simple so we can just like. Okay, so this, for example, price right here on AUD Japanese yen, this is a currency pair, you're gonna see this previous price right here, whatever this was, 75.45. Let's just put like a line right there, and then look what happened in the future. This was the 6th or 7th of November 2019. Well, prices come back to this area back in the 12th of December 2019. So, a little over a month later, price came back to that area, and what happened right here? Well, we saw price react at that previous price. We saw price pull away from that level. And then now price is currently at this price level again. And, we may see price pull away. We may see price break above and then come back for a bit. We could see a lot of different things happen. But that's the logic behind it, is that price is going to react at previous price levels. Let's look at some more examples of this on the chart. We can see that for some reason price decided to stop in here a couple times. So price came, it bounced here at this price, bounced the second time at that price, came down here, it went below this price, but then jumped again. So it essentially still bounced at it, even though we had price leak below that previous price. Price still went below that price, but it bounced right back up. So this essentially, for some reason, somewhere in this area, price tends to react right there. People tend to buy there in that area on the chart. And like I said, the only thing you're doing is you're just drawing a line on your chart to show, hey, price is reacting at these previous prices. Reacted there is bounce and bounce and bounce and bounce and bounce. So that being said, price levels are simply areas of interaction on the chart where price bounces around at its previous prices, and you're just connecting those with a line. Okay, so we're going to get more into this here in a second, but I just want to lay out the concept to you and show you that. So far, breaking into technical analysis, what we've been through is technical analysis is the use of market history. So we've looked at what market history is and how price bounces around and how you can look at a chart. And then it's the use of market history and common patterns in market data. So we've also looked at common patterns within market data, such as like price bouncing around at certain levels. And then we can represent those levels by just drawing a line. And then we're going to common patterns in market data to identify trends and make predictions about what price is likely to do in the future. So what this would mean is that, like, if we're looking in the past and historically price has just been going up, and it's been going up some more, and it's been going up some more, it's been going up some more, we can use this to like draw these lines in the chart. That is so bad. We can draw these lines on the chart, we can draw our price levels, and then we can make a prediction to say like, hey, I think price is going to continue up based on the price history. So essentially, let's break it down again just to make it plain and simple. Technical analysis is the use of market history and common patterns in market data to identify trends and make predictions about what price is likely to do in the future. That is technical analysis as a whole. And so you got to have each one of these components to do that. So you got to have a chart with price history. You have to know what the common patterns in the market are. And then you have to be able to apply this so that you can make predictions about what price is likely to do in the future. So that being said, we went over price levels, but how do we be more scientific in our approach to price levels? Because so far I've just told you like, hey, if price starts bouncing at a level, you just draw a line connecting that. Well, I'm going to break down the 3 different styles of this. So that way you know what they are. And essentially it just boils down to 2. There's 2, but there's 3 within that 2, if that inception makes sense with you. So first there's horizontal price levels. And there is diagonal price levels. And then what these are is, if we're being more specific, horizontal price levels, we call them support and resistance. And then we're going to break this down here in a second. And then diagonal price levels, we call those trends. Now, this being said, with horizontal price levels, we can break them into two things, and that's support and resistance. So essentially, whenever we're looking at what support and resistance is, support is where price comes and then bounces along a floor. So a floor, that means price comes to the level and then bounces upwards. Support, price comes to a level and then bounces upwards away from the level. Resistance is the exact opposite. Resistance, you can consider it like a ceiling. Resistance is where price hits a price and then goes down. Resistance is where price goes to a certain area and then goes down. Resistance is where price comes up to a ceiling and then goes down. So support, price bounces upwards, and then at resistance, price bounces downwards. Okay, so support means price is supposed to bounce there and go up, and resistance means price typically comes there and then bounces down. And both of these are just the two variations of the horizontal price levels. And the interesting is that what you'll learn as you go through the course is that once price keeps hitting these levels, typically when price breaks above it, if price comes back down and revisits that previous price level, typically what you'll see is price will start interacting with that level and bouncing at that level, which also helps us in our venture to try to identify what price might do in the future, which is how we make money, is by trying our best to predict which way price might go. So horizontal price levels can be broken down support and resistance. In this case, this would be support, and then these all right here, in this case, price would be acting at resistance right there at this horizontal price level, which we can just call resistance for then. And then when price bounces there again, you can call that support because price is now turned from resistance and then now it's reacting as support. But worst come to worst, you can always just call it a horizontal price level. It doesn't really matter. Support and resistance can be used interchangeably depending on what price is doing at that level. If you just want to keep it plain and simple, just call it a horizontal level. So diagonal price levels or trends. So I'm going to, here, let me just clean up this chart just a little bit. All right, so let me put that back in. Horizontal price levels, trends. So it's, whoa, I meant to put diagonal. All right, you can see my 10-year-old preparation in making this video. So diagonal price levels essentially just means trends. Now, what are trends? Trends are when there is a clear direction within the market, okay? So for example, if I was to tell you that, look at price doing this and price is currently going like this and this and this and this and this. If I was to ask you to tell me, hey, do you think price is going upwards or downwards? In this case, like 99% of people would look at this and say, yep, it's pretty clear. Me and my whole family and my grandma and my dog, we think price is going up because it's just that clear, like price is going up. What about if price is going downwards? So in that case, price would be doing this, be visiting lower prices, and then we would see lower prices and the lower prices and lower prices. So if you ask, you and your family and then your grandma and then your extended family in India, like me, like I'm half Indian, I've got extended family in India, and then you ask the Indian family's village's dogs and you ask the puppies of those dogs, most everyone would probably say like, yeah, it looks like price is just going downwards. And so essentially you have diagonal price levels or trends broken down into two things. And those two things, very simple, as the name would suggest, an uptrend and a downtrend. So within these two things, uptrend or downtrend, it just means you're looking at the chart, and if you think it's going up, if it looks like price is going up, you're just going to call that an uptrend. And if price is going down, you're just going to call that a downtrend. Okay. Now we're going to visit how to like draw trends and like, do all that. This is just to introduce you to the concept of price levels. So that's how it is. So now that we've learned about horizontal price levels and diagonal price levels, let's put it together. Price simply, it's on a chart and it's doing all this and it's making all these little squiggly lines and it's doing a bunch of different stuff right here. So essentially all you're doing is you're looking at a chart, you're identifying the very clear horizontal price levels as well as only the very clear diagonal price levels. And then within those diagonal price levels, you're going to call those diagonal levels trends and the horizontal levels support and resistance. That's all it is. And the idea is that price tends to bounce around within these levels. Okay. Now, nothing is guaranteed and price does not respect these levels perfectly. with my 10-year-old diagonal drawing skills. Let's see if I can get it right here. So the idea is that price just bounces around within these levels. So for instance, if price was to like visit this trend up here, and let's just say that price would go and hit all the way up there, and then it hit right there again. Then it came down here and did all this. Then it hit right there. Let's just say price came up and hit that level right there, and then there, and then there. The idea is that price will generally continue in this trend and keep on going downwards until it gets to the trend, and then instead of like bouncing away from it, price starts breaking above it. And then what price will do is then price will get into another trend, go in another trend, and then price will break its previous highs, come down, visit a next price right here, and it'll break above, act as support, and it'll keep going up. And price just does this over and over. It goes uptrend, then downtrend, and uptrend, and downtrend, and uptrend, and downtrend over the course of days, weeks, months, years. There can be all sorts of different trends, but it's essentially meaning all you're doing in the Forex market is just looking at these squiggly lines in your chart and drawing horizontal and diagonal lines, and then you're anticipating that price is going to bounce around within those lines. Now, like I said, we're going to break down step by step in detail how to draw these lines, which lines are, good and which lines will be better than others, and then like how to sort of put it all together and stuff like that. This video is just to introduce you to the fact that with technical analysis, you're using market history and common patterns in market data to identify trends just like these and make predictions about what price is likely to do in the future, since the idea is that price tends to bounce around within these lines on your chart, these support and resistance horizontal levels and these diagonal trend lines. So here is some other thing you need to know, which is whenever we're looking at these charts, remember I told you about time frame and like the timeline of when these events happen. It could happen over the course of 10 years, 1 year, 1 month, 1 day, 1 minute. So what we use to identify these areas is what's called the daily and the H4 chart. You can say, just chart. So whenever you're here looking on TradingView, you know how you've got these little timelines up here that you can use? The D means it's like the daily chart, so like the 1 day chart, and the H4 or the 4H means 4 hours, so the 4 hourly chart. And just like you learned in the previous video, that just means that like on the 4 hour chart, every single candle represents 4 hours worth of price data. And then on the daily chart, every single candle represents 1 entire day's worth of price data. So what you're doing here is whenever you're drawing these trends and whenever you're drawing these horizontal levels, you're simply just going to the daily and the H4 chart only, and that's it. And you're just finding the areas where price has just interacted with in the past. In areas like these down here, where price is just like, bounced around in the past at like price looks like it bounced right there once and then a second time right here. And then if you draw these levels where they're most clear, you can then use those to help guide your trading decisions. Now, the reason we don't go into lower time frames like the 30-minute, 15-minute, and 5-minute is because it seems to work less consistently if you do it on those time frames. What works the most consistently in my 4 years of trading is the daily and H4 charts. And if you make pretty much all of your trading decisions just based off the daily and H4, it's a lot harder to get confused and start doing some really weird stuff. Because whenever you go into the 5-minute chart, it's just such a low time frame and you're going to be drawing all sorts of weird trends and it doesn't work as better. What works great is just going to the daily and H4 because that's the overall direction of the market. If we go into like a super low time frame like the 15-minute, you could be looking for like a trend like right here, right? So you could be seeing like that's a downtrend and that may work for the time being. However, what's going to happen whenever that little downtrend you drew right there, in the grand scheme of things, that little trend right there was very, very small and like doesn't even compare to the overall direction, which in the big grand scheme of things, price is going upwards. You don't want to be like trying to look for like a downtrend and trying to sell if price is going up. That would be like you buying your Porsche brand new for $150K and you can sell it for $180,000, but instead you sell it for like $130,000. Like that wouldn't make sense. You wouldn't want to sell whenever the market's going upwards. If the market's going upwards, you want to buy and then you want to sell at a higher price because you anticipate the market's going to go upwards. So that being said, we only look at the daily and the 4 hour charts because that's what seems to work the most consistently based on my 4 years of trading experience. And a lot of other people who trade full-time profitably will tell you the same thing. They're going to say you're going to be safest if you just stick to the daily and the H4 chart. So that's what I teach. That's all the trades that I share. I don't do anything else. I just do the daily and the H4 chart. every now and then I'll dip into the 1 hour chart, but it's usually just to look at what candlesticks are doing and wicks are doing and what price is doing at a certain level. But that level is always going to be based in the H4 and daily charts. Okay. So that being said, another thing about these levels in the chart, you may see that just based on the past few examples, price may do something like that where it dips below a level, but then it comes up, then it starts bouncing and bouncing, then it goes up, goes past this area, comes in, then goes right here, and then bounces, then it goes a little bit lower, and then bounces right here. So if you were to draw a line, you see how price like slashes through that line sometimes? It'll slash through it. And then also you see down here, if you draw a line, you can see, well, hey, price slashed through that once before. Well, you can get around that by drawing boxes in place of support and resistance. So for uptrend area, you know, we could do something like that. That would be pretty easy to just connect with a line, just connect all the highs and lows, whatever. And then if we're looking to identify the support resistance, we could say we're going to start right here with a box, and then we're going to end that box up here. Okay. Try this again. Really hard to do with my MacBook Pro trackpad. Right here to include all of this price data. And let me just show you in the actual real chart. So that way it becomes more clear. So for instance, this is a trade that I'm in right now. I'm up like 1,500 bucks on this trade right now. And as you see, I have this like little horizontal, this rectangle area. In TradingView, you can use it. It's right here. You can select rectangle. I have it on my favorites, so it shows up in my toolbar. So you can click that, and then you can draw a box. And what you can do is you can use this box to represent data that it doesn't line up perfectly. So for instance, this right here, you see how I've used this line right there? That line is because price looks to be very clearly respecting that area. So I don't really need a box there. I can just easily do that with a line. However, over here, price, I knew that for some reason, price was interacting with this area right there, and then right there, and then right there, and then right there. However, I didn't know exactly what it was, because if I was to try to draw a line, it would be kind of weird, right? Like I would have to like either do that or do it something up there, and then it like breaks this area. And so what's easier is just to say, hey, I don't know exactly where price is reacting at, but it's doing it somewhere in this area. So I'm just going to put a box to represent that area as a potential support zone. And then whereas in this case right here, it looks a lot more clear. Like you can see that it like bounces support right there, right there, a little bit of leakage, right there a little bit. And then you can see this goes up. And even then you could have used like a box for this too. It really just depends on what you see. You're free to use either a box or a line. It's not that important. The idea is just to not get confused and just draw support and resistance zones in your chart where they're the most clear to you on the H4 and daily charts. So I just want to show you, you can use either a line, and you can also use a horizontal box to draw those horizontal levels. Trends are best if you just try to draw a line, because if it's bouncing very clearly at that trend, it'll respect it very nicely. And then, yeah, so you can just draw a line for trends. Horizontal zones, you're free to use a line or a box. And like I said, we're going to examine that more whenever we go into the next videos, which is like how to draw support and resistance, and how like the things that you should do, the things you shouldn't do, how to draw it in a way that keeps it simple, stuff like that. So another thing, whenever we're looking at what price is doing, price, remember I told you how it'll like go down here and it'll come up here, then it'll go down here and it'll come up here again, do this. So this is like pretty much what characterizes a downtrend, is it's like, you know, lower lows and lower highs. So what this means is that every time price interacts with an area and bounces away clearly, that's a low. So we can just like mark off a few of them on here in the chart, like that's all low. And then other areas where price like falls away and reverses at to the downside, like at resistance, we can all call those highs. So I was just going to put this in here. That would be a low. Up here would be a high. Up here would be a high. And then up here, this would be a low. Now there's something interesting I want to show you, okay? Whenever we're looking at these charts, we can see that it's all relative, just like Einstein's theory of relativity. Yes, we can still call this a low, and yes, we can still call this a low, but within a downtrend, it's all relative, right? Like the reason you call it a trend is because it's relative based on what's happening at the moment. And the only reason this right here has made a low and is going down is because it's lower than that one. That's what characterizes a downtrend. Same thing with these highs right here. Like this is still a high, yeah, but it's lower than this previous one. So what we're going to do is whenever we're looking at trends, we just look at the previous peak, the previous like high or low, and see where it's at. And if it's higher than the previous one, or lower, we're just going to include that in the next one. So for instance, if this is a low right here and this is a high that was made, well, this high right here is going to be lower than that first high. So we can call this a lower high. Same thing right here. This is still a low, yeah, but compared to that previous low that price made, it is a lower low. So we can put lower low. Same thing with this right here. What would this be? This is lower than the previous high, and it's still a high, so we'd call it a lower high. This down here, this is a low, but what is it compared to the previous one? The previous low up there, this is a lower low. Lower high. And then let's say that price does this thing right here, where it stops, goes upwards, then it comes down, and it goes up, and then it starts doing something like this. What are these? Let's look at these. So we have a lower low right there, but then we have another low right in here. So we know that's a low, but compared to this previous low, is this one higher or lower than that one? This low right here is higher than this previous low. So we can call this right here a higher low. What about this high? We know for a fact that's a high right there, but we look at the previous high, which was right here, and is this higher or lower than that one? It's very obvious. This is higher. So for instance, right here, we can mark that in. Compared to the previous high, that's a higher high. Same thing with this low. It's a higher low. We look at the previous low, it's higher. With this high, it's bigger, it's further up than the previous high. So price has made a higher high. Higher high. Same thing right here. This is a higher low. Let's say price goes up here and then reverses. We can say that's a higher high. And price is going to keep doing this over and over until it breaks out of this like little pattern. And then it starts falling, and then it'll start making lower lows and lower highs and going an uptrend, downtrend, and the pattern just repeats itself over and over. So all you need to know is that the clear areas where price reverses in the chart, you can label those as highs or lows. This happens all day, every day, and it's all relative to what time frame you're on. Like I said, you're going to want to stick to the H4 or the daily chart. What characterizes an uptrend? Price making higher highs and higher lows. What characterizes a downtrend? Price making lower lows and lower highs. So if we're looking at this New Zealand dollar, Japanese yen on the 4-hour chart, we can see that price is clearly making like a high right there, and then it's made a low down here. And it's also, these are both higher and lower than these previous ones. But then we could see price in here, you know, it's making this higher high, this higher high, and then price comes in here and makes a low. But this low is higher than that previous low. So then price goes up and then it bounces right here. Then it bounces right here and bounces right here. So prices put all these lows in, and these lows are all higher than the previous low that was made. So then price is making like a higher low. Same thing right here with this high. Prices come in here. We have a high before it reversed and fell back down. But this high is higher than this set of previous highs in here. And maybe that's not that clear. But this is all clear, right? There's a high there, a high there, a high there. This one is higher than all those. So it's a higher high. So higher highs and then higher lows, higher high, higher low. This signifies what an uptrend looks like. However, if we were to look at a downtrend, what constitutes a downtrend? Well, that's a high right there, right? And then this is a high, that's 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 a high. What are all these highs doing after that initial one that we see? These are all going downwards, right? So all of these in here across the chart happens all day, every day. We can look at these all as lower highs. Same thing right here. Price made a low right there. Lower low right there. We have all of these in here, like a lower low, a lower low, lower low, lower low, lower low. So these are all lower lows. And all I've done is I've just simply connected these to show that price is going downwards. This lower line right here is not necessary because whenever we're drawing a downtrend, whenever price is in a downtrend, all you're going to be doing is a sloping line on top. You don't need one underneath because you're just looking at where the highs are. Same thing with buys. If price is in an uptrend, all you're doing is looking for a sloping line on the bottom. That's it. You don't have to put the one in on top if you don't want to. If you just do it like that, that just kind of shows that price is within a channel and it's bouncing around within those prices, but you don't need it. With a downtrend, sloping line on top, uptrend, sloping line on bottom. What does this do? What this does is it shows you clear areas to buy at. Okay, because if you have a line on top, you're not looking to sell within an uptrend. Like you don't want to do that. That would be very goofy and very silly. You're looking to buy. So naturally, you want to buy whenever price comes back to retest its uptrend area and then its previous prices, which is, like I said, you're going to learn all that and like how to plot these levels in your chart and then how to actually trade them in the videos later in the course. But right now I've just introduced you to like what highs are, what lows are, higher highs, higher lows, lower highs, lower lows, and then what characterizes trends, which is a series of higher highs and higher lows for an uptrend and lower lows and lower highs within a downtrend. And I've labeled them on the chart for you so you can see that. And here's what it really boils down to, which is like the basis of this whole trading system. And I'm going to say this twice so that way you can write it down. I'll say it for the first time right here, and then I'll go slow and break it down after this. So when trading, you are simply looking to identify a clear trend on the daily and H4 chart, and then trade breaks and retests of horizontal levels within that trend. That's what it boils down to. You're going to learn about the dynamics and the individual specific things about what a break and retest is, and all the different things like that. But let's break it down again. Let's go real slow. Let me break down what I just said. This is the whole concept of what you're trading. This is all you're doing. If it all boils down into one sentence, this is what it is. When trading, you are simply looking to identify a clear trend on the H4 and daily chart, which is what we have right here. And then you're simply looking to trade breaks and retests of horizontal levels within that trend. That's it. So you have horizontal levels and you have the diagonal level, which is the trend. You're simply looking for price to break previous prices and then come back and do this right here, which is called a retest, where price revisits the previous prices that it was at, that it just broke above or just broke below. That's called a retest. And like I said, you're going to learn all about that and how to actually trade that in the upcoming videos. But that's all you're doing. A clear trend on the H4 daily, waiting for price to break above the previous price, come back and then retest it. And then same thing. And you just keep doing this over and over. And then eventually someday or sometime the trend will break and it will no longer be like an uptrend. And then maybe a downtrend will form for a while. And then you'll simply look to do the same thing. You'll identify a clear trend, identify clear horizontal levels, and look to trade breaks and retests of those clear horizontal levels within that trend. That is all you're doing in trading. So I'm going to say it again for you, just so you know, and just to make sure you have it written down correctly. And then after this, you can pause it, make sure you have it written down. Here's what you're looking to do in trading. Here's what this whole course boils down to. When trading, you are simply looking to identify a clear trend on the daily and H4 chart. And these can be used interchangeably. It can be the daily or the H4, whichever one seems to be more clear. And then trade breaks and retests of horizontal levels within that clear daily or 4-hour trend. That's it. You're simply looking to identify a clear trend on the daily H4 chart and then trade breaks and retests of horizontal levels within that trend. That's all you're doing. That's why this course is so simple. So that's all I focus on in this course, is just teaching you the dynamics of how to make sure you've identified a clear trend, how to make sure you're identifying clear horizontal support resistance levels, and then what to look for when price breaks it, and then what to look for when price comes back and retests it, how to enter, where your risk should be at, where your profit target should be at. We go into all that dynamics later in the course, but this was just an introduction to market structure so that you know pretty much what you're doing. Price is just bouncing around within these horizontal and diagonal levels on the chart. Your job is just to identify the clear trend and then identify when price breaks previous prices and then comes back and then retests them to make money, to capitalize on that. And of course, you're doing this all with controlled risk, with clear risk parameters. You're always going to know exactly how much you're risking per trade, and you can choose how to do all this all yourself. So that being said, I'm really excited to get into the next video with you, which is how to draw support and resistance levels. So I will see you guys in that video. Make sure you've reviewed your notes and make sure to go over this video a second time if anything didn't make sense or if anything is if you need more detail on it. Cheers.